All right, welcome to Coffee with Marcus and Mark, the number one stock market show on Spotify and one of the most popular market updates on YouTube. And in this show, we are going to talk to you about what's happening in the markets and how we are trading it. And there's never a dull moment. Today's Tuesday, March 14th, and yesterday the Dow dropped for its fifth day straight, and bank stocks are falling. And today we had the CPI inflation data release. So, how are the markets reacting to this? And more importantly, how are we trading these markets? By the way, if this is your first time here, I'm Markus Heitkoetter. This super smart guy over there is my head coach, Mark Hodge. And we're real traders who trade live accounts. So, therefore, we got a lot of trading experience, and we're showing you how we trade these crazy markets. So, trust me, we know our stuff and we're not afraid to tell you like it is. So, if you're here looking for some honest insights into the fascinating world of trading, you are in the right place. And in these days, if you miss a day in the markets, you're wondering, what is everybody talking about, right, Mark?
Oh yeah, I mean, just huge swings. We go from the sky falling to now a nice day, a nice move. Are we worried about the Fed? Are we worried about interest rates, or are we worried about banks collapsing? I mean, it's been a wild ride over the last couple of days.
Yeah, so on Thursday and Friday, banks were definitely in focus with the collapse of SIVB Bank, Silicon Valley Bank. And then yesterday, a little bit of the aftermath of, okay, what's happening? Was this an isolated incident? Another bank came into the headlights. And then, of course, we also had the CPI data coming out today. And if you just look at yesterday, we see that yesterday we opened lower in the S&P 500, moved higher, and then a little bit of waiting because we want to know what the Fed is doing. And we talked about it yesterday. The Fed, a little bit in a tight spot because, on the one hand, if they keep raising interest rates as aggressively as they were planning to do it, we could see more trouble in the banking sector. But on the other hand, we also need to make sure that they are fulfilling their mandate of keeping inflation under control.
Yeah, it gets a little tricky, and then also the concerns whether or not the Silicon Valley Bank, basically a bank run, was an isolated situation because of their longer dated securities and really not being hedged. It does seem like although regional banks could have some risk and exposure there that the big banks don't, it does seem like it was isolated. And Marcus, just to put it into perspective, I saw this number. $42 billion dollars was withdrawn on Thursday. That's $4.2 billion an hour. And the largest bank run previously in modern history was Washington Mutual Bank in 2008, where 16.7 billion was withdrawn over 10 days. So the Washington Mutual Bank concern in 2008, that was 16.7 billion in a 10-day period versus Silicon Valley, which was $4.2 billion an hour. So it was no joke. On the other hand, I saw a tweet from our friend Michael Burry. I just call
Oh,
him our friend because he's the infamous fund manager that called the subprime mortgage crisis
right.
and was based on the Big Short movie. He said this crisis could resolve very quickly. I'm not seeing any true danger here. So is the issue over? Well, I don't know if it's the market's higher because they think it is, or if it's because of the CPI report that came out this morning.
Yeah, we should talk about the CPI report. So it was released this morning. Let's first take a look at the numbers and then dig into this. So this morning, pretty much in line with expectations. So CPI increasing 0.4% month over month, which is in line with expectations, lower than the previous month. And also year over year, it came in at 6%. And previously it was 6.4%. So all of this is looking pretty good. And this is where I saw this. Let me just see if I can open this in another window now, but you get the idea. This is where we see how inflation CPI is coming down. So that's the consumer price index now at 6%. And then we also have the core CPI. And this is where this morning we saw a little bit of a surprise because core CPI came in higher than expected and also higher than the previous month.
Yeah, and I think all things considered, it was a positive CPI report, but core CPI, which excludes food and energy, which tends to be a little more volatile, so they have this number to kind of exclude some of the bigger movers or fluctuations that might not represent inflation that like you would you would expect or want. So a little bit higher, but I think the year over year here says a lot. And going from 6.4% year over year last month to 6% now, looking at that chart, I mean, and that's what the Fed wants to see.
That's exactly what they want to see. And this were also looking into this of what's happening here. It seems that housing costs are a key driver of inflation figures here. And this where shelter cost jumped 0.8%, bring the annual gain up to 8.1%. So that's a big deal here. But this were one of the chief economists here, Lisa Sturdivant, well, you can read it up here, said, well, the problem in the housing data is that it takes up to 6 months to really see the correct data. And this is where I saw that Fed officials have now turned to a super core, saying, okay, now we are taking the core CPI and we're excluding shelter and housing costs. And then, hey, it's only 3.7% from a year ago. So it's kind of,
Interesting.
okay, we see what we want to see, but hey, the markets are reacting positively to this because if you look at a 5 minute chart of the S&P 500, we see this morning opening higher and up and away so far.
Yeah, and I mean, a nice move across the board. Uh, the the S&P almost up 2% for the day, and like you see just there, really just straight up and away, and the Nasdaq up over 2%.
Yeah. What's super interesting today, so the stock markets, the stock indices are up, and the 2 year yield is up, which is a little bit surprising because usually we have the inverse relationship here between stocks and the yield. So, meaning that when the yield falls, this is when stocks are rising and the other way around. So, this morning, coming back here, actually up 8.7% for the day.
Yeah, and then I think it just goes to show that there was that overreaction to Silicon Valley Bank, and just the worry there and concern, because that's a 25% move from the top to the bottom with that swing. That's a huge move, and it's because the focus turned to buying bonds, right? The flight to safety. We saw gold up, we saw bonds up. Bonds going higher means yields are falling. But then after the overreaction or some news has come in and making investors a little more comfortable, you're seeing a quick pop back in the 2 year, really the 5 year, and a little bit on the 10 year as well.
Yeah. So the question now, what will the Fed do next week when they have their next meeting? And right now, it seems that we are back to the 25 basis point hike, the quarter percentage point. And, we've been talking about this. You were in the camp 25 basis point all along, even when it
Yep.
went crazy. And some said, oh, they have to raise interest rates by half a percentage point. Yesterday, we saw quite a few people who said, well, they can't raise interest rates anymore. And now we're kind of back to what we always thought would happen. So back here, back in line, basically.
Yeah, and that's the thing. I still think the 25 basis point is what the Fed's going to do, and I mean it's priced in to the market right now. That's what traders are expecting, so no surprise there. But no hike seemed a little bit over exaggerated, and even the 50 basis, I think that was a little unwarranted. We'll see. My guess is that the Fed raises by a quarter point, and they're a little more softer with their wording, but saying that they will still make their decisions and make it clear about um, data being a crucial part of whether or not they're raising and when they stop. That's an interesting chart there, Marcus.
Right, because yesterday it seems that they would stop just shy of the 5%. This morning, as said, back to normal after this overreaction. Looking at probably a terminal rate that was previously indicated of 5.1, 5.2%. And again, it's all about the wording next week because previously we didn't see any lowering in interest rates for the remainder of 2023. Now it seems that as early as September, we could see interest rates falling lower and two more possible interest rates hike. So yeah, it's all about data, data, data. That's what Powell said last week when he was testifying in front of the Senate and the House.
Exactly. And so CPI data, traders responding positively. Tomorrow, we also have more data with PPI coming out.
Right. Then we also have Bauman speaking today, Fed member, but this will be the last speech because then they are in the blackout window 1 week before the Fed meeting. So we will see what happens next week. And markets are just remaining a little bit nervous. Now, one of the things I want to bring up, because also when you blink, you miss it. Bitcoin, look at this. After
Wow.
Bitcoin was reaching 25,000, just in February, it was dipping below 20,000 last week. Now a huge, massive run. I mean, this morning, trading even above 26,000 right now, pulling a little bit back. So, I mean, this is not a flight to safety. This is like, okay, interest rates are probably not going as high, and we are seeing a little bit of a run back here into risk assets.
Yeah, interesting. You pull back to its 200-day moving average on that pullback that we saw, ending on Friday, and then now, I mean, this one is surprising, but it seems like you said, risk assets traders got excited about the concerns and worry, and decided that it was an opportunity to get some crypto.
Yeah. All right, let's take a look at our positions and what's happening here with our positions. So, first one here, CTRA, Quotera Energy. This is where you got out of it a couple of weeks ago. No, it was last week. Right. So
No,
I'm
it's two
still
weeks.
in it. They have ex-dividend date tomorrow. So if I still own the shares by the opening tomorrow, I'm entitled to the dividend, which will be paid in a couple of weeks from now. And yeah, this is why right now I'm not interested in selling any calls against my existing position, but nicely trading here at 25.16. My break even is at 24.67. So I think I'm in a pretty good position here.
Yeah, and yesterday with that pullback, I was looking at selling puts again on CTRA. I decided to go with Oxy instead. So I was looking at both Oxy and CTRA. A little correlation there. So I really wanted one or the other in case there's a little more downside today after CPI. The Oxy trade worked out great. I was able to close it for 80% max profit, just got filled on that exit. So a real
Oh,
quick trade, some nice profit there.
perfect. Yeah, this was just a great trade that presented itself yesterday because yesterday, as I said, the sky was falling. So there were definitely some buying opportunities. Google, the Googles, I'm still in Google, looking good here today, up 3%. Again, reacting with the overall market. I sold 87 puts here as part of my rescue mission because I am assigned at 108. Want to bring down my cost basis here, but those are also looking good. I might be able to close them today or tomorrow. And I mean, if I can close them today and then we have another push lower, I'm definitely interested in selling those again. I already sold them twice. And so collecting money while Google is trading here below my break even point right now.
Yeah, nice management there, bringing down that break even, and Google behaving nicely right now, even though it's not rallying up back up to your cost basis yet.
Not yet, not yet. All right. PNC, the PNC position that we entered right before the news broke. So I sold the 147 put, you sold the 146 put. We both got assigned on Friday. I jumped the gun a little bit on Friday, a little bit earlier, bought more shares. So right now, my cost basis is at 141.50. You bought some more shares yesterday. Your cost basis is at 136. You are in an excellent position here.
Yeah, the 136 cost basis looking pretty good. Today, we were trading a little higher. I mean, we actually got up to 138.70, so I was making money on the trade. I was hoping we'd see a little more follow through, get a V-shaped recovery here, get back up towards 146, so I could really get some nice premium on any calls above 140. But a little bit of a reversal after a strong start. Still up for the day, but it was up, I think 5% at the open.
Yeah, and I think we will see this because right now everybody is still trying to figure out okay, last week, SIVB, was that an insulated incident? Because we had another bank over the weekend reporting that there's trouble. This morning, Moody's came out and put 6 banks on the list where they say, well, these 6 banks could be in trouble. So right now, still a little bit of nervousness there. I'm not concerned about this position at all. I think Even with my 140, 150, I'm in a good position. You're in an even better position. So, I mean, this is something that we can probably sell calls over the next few days. And as we see, lots of volatility here. So, moves of 5% up or down are not unusual here at all. Right now, it's still up 1% from yesterday's close. So, we'll see how this shakes out.
Yes, indeed. Yes, indeed. Still up though for the day. I'll take that.
Yeah. Now, since I'm flying or I sold more puts on Google, this counts for me as a second position. So for me, I'm full here with CTRA, Google, Oxy, and PNC because I like to have up to 5 positions in my portfolio. And with flying a rescue mission of Google, I count this as 2. And there's also not too much going on today because the markets are just, I mean, the S&P now up 2%. We'll see the 200-day moving average today. Will it hold as resistance, or can the S&P slice through this and then also close above 4,000, hopefully sometime soon, and close above the 50-day moving average again?
Don't blink or you might miss it.
You might miss it. You might miss it. All right. Last thing that I want to look at, but before we do this, let me just know if this is helpful at all that we are running through our positions and letting you know what's happening in the world of trading. If it is, give us a quick like and consider subscribing to the channel. We are close to 100,000 subscribers, so every subscribe count. All right, let's take a look at the VIX, the fear gauge. I mean, yesterday jumping above 30, so dramatically, while it has been trading around 20. Right now, pulling back down 15% for the day. So, is the panic over?
Could be, could be. I mean, we've been in a nice lower range for a long time, and then we have this, VIX spike, and that's very common where you get that spike, a little bit of an overreaction, a little panic, and then it subsides. VIX still above its 3, 5, and 10-year average right now, so a little bit elevated, but a quick reversal since the last 3 days that we had moving higher.
All right. Well, long story short, never a dull moment. And with more economic data coming out tomorrow and the Fed saying that they keep a very close eye on data, we can see another moving event tomorrow, market moving event tomorrow. So make sure that you tune in today's CPI data in line with expectations. If this is what we see from PPI as well, we might see a little bit of a follow through, and maybe we will see that the S&P is slicing through the 200-day moving average and closing above it again, which would be fantastic.
It would.
All right. So if you would like to learn more about how we trade these markets, take a look at these videos. So there's a couple of videos for you popping up. And again, subscribe to the channel, help us to get to 100,000 subscribers, and then we'll see you again tomorrow morning.
Happy trading, everybody.